Owning a house. That used to be the dream for many families, but lately things have gotten tough. House prices are way up, and getting a loan is harder too. It's like buying a house has become a super difficult thing, but this isn't the end of the story. We're going to explore what's happening in the housing market and see what it all means for you. So get ready for some interesting facts about buying a house today. The American dream of homeownership seems to be slipping further out of reach for many families. Home prices are hitting record highs, and to make matters worse, mortgage rates are climbing too. On top of that, there's a nationwide shortage of houses available for purchase. This combination is making it incredibly difficult for many people to afford buying a home. But the recent jump in mortgage rates is particularly concerning. Just 2 months ago, rates were trending downwards, but they've now climbed back over 7%. This increase is causing a significant drop in the number of people applying for mortgages. Experts are advising potential homebuyers to be cautious in this environment. While some might see a high home price as an opportunity to lock in a good investment, there are hidden costs to consider. Property taxes and homeowners insurance are also based on the value of the house, so these expenses will also be at an all-time high. Renting might be a smarter option for many people right now. It allows them to save money while they wait for the housing market to cool down. Ideally, Federal Reserve interest rates will come down in the future, making mortgages more affordable. However, the future of the housing market is uncertain. Some believe that if interest rates drop, home prices could actually go up even further due to increased buyer demand. This is because there's a limited supply of houses available. The high level of consumer debt is another factor that makes the situation unpredictable. The key takeaway here is that there's a lot of risk involved in both buying and not buying a house right now. Owning a home can be a great way to create lasting memories with your family. If you're planning on staying put for at least 5 to 7 years, then rising and falling interest rates become less of a concern. Even if rates drop in a couple of years, you can always refinance your mortgage to lock in a lower rate. But if you're only planning on staying for a year or two, buying a house right now might not be the best decision. In California, the housing market is facing a unique challenge. State Farm, a major home insurance provider, is demanding a significant increase in rates. 30% for homeowners, 36% for condo owners, and a whopping 52% for renters. If these demands aren't met, State Farm is threatening to leave the state altogether. This would be a major blow to California's housing market, leaving millions of residents scrambling for insurance. So, what's behind State Farm's ultimatum? The company points to several factors. The cost of rebuilding homes after wildfires has skyrocketed by 31% in the past 5 years. This is due to inflation in labor, materials, and subcontractors. Additionally, State Farm argues that California's wildfires are becoming more frequent and severe, driven by a combination of climate change and poor forest management by the state. With the cost of living already high in California, rising insurance costs are making the dream of homeownership even more out of reach for many residents. This situation isn't unique to California. Other states like Florida and Louisiana are also facing insurance crises. Major companies like Geico, Tokyo Marine, and Transamerica are following suit and leaving these high-risk markets. While some insurance companies are pulling out, others are staying put, for now. However, this creates uncertainty for homeowners who may struggle to find reliable insurance coverage. The situation tells us about the delicate balance between providing affordable insurance and managing risk for insurance companies. They are for-profit businesses after all, and they need to be able to operate profitably in order to continue serving their customers. The California housing market is in for a rough ride. State Farm, a major home insurance provider, is demanding a significant increase in rates, 30% for homeowners and even more for renters. If the state doesn't agree, State Farm is threatening to leave altogether. This would be a huge blow to California's already struggling housing market, leaving millions scrambling for insurance. But why is State Farm making such a drastic demand? The company argues that it's simply not profitable to insure homes in California anymore. The cost of rebuilding after wildfires has skyrocketed in recent years due to a combination of climate change and poor forest management. Additionally, California has a high crime rate and a growing homeless population, factors that also make insurance riskier and more expensive. This situation isn't unique to California. Florida is facing similar challenges, with insurance companies pulling out due to frequent hurricanes and rising flood risks. It's a tough spot for these states' governors. They want to keep insurance affordable for residents, but they also need to create an environment where insurance companies can operate profitably. It'll be interesting to see how California responds to State Farm's demands. A 30% increase in homeowners insurance is a big pill to swallow, but the state may not have much of a choice if it wants to keep a stable insurance market. Meanwhile, the job market is showing some signs of cooling down. Wage growth has slowed, and unemployment has ticked up slightly. This could be good news for the Federal Reserve, which is worried about inflation. However, there's a hidden side to this story. The number of full-time jobs is actually dropping, while the number of part-time jobs is rising. This could lead to a situation where there are fewer good jobs available, which could put downward pressure on wages in the long run. So while inflation might be under control for now, there are other challenges lurking on the horizon. The current economic situation shows softness, with fewer good full-time jobs and more people taking on second jobs and side hustles. The jobs report isn't capturing many cash-only side hustles or 1099 gigs like weekend Uber driving. With interest rates potentially lowering this year, this trend could be significant. The Federal Reserve, Fed, might consider a rate cut in September if job and wage growth aren't fueling inflation, as they aim for a 2% inflation target. Many people are seeking advice on creating secondary incomes or transitioning to new industries, especially due to layoffs and cooling in certain sectors. There's a notable interest in starting side hustles and finding the right job fit. And it means something in the context of the upcoming election, as Trump appears favored to win based on three key issues: the economy, immigration, and women's healthcare. He leads on the economy and immigration but trails Biden on women's healthcare. As mortgage rates climb to 7.7%, these economic factors may play a significant role in shaping voter opinions, but also it means that homeownership dreams will be a distant dream because they are dealt another blow, exacerbating the already dire affordability crisis plaguing the housing market. According to Freddie Mac's latest survey, the average interest rate for a 30-year fixed-rate mortgage jumped to a staggering 7.17%, a significant increase from just 6.43% a year ago. This rise makes it considerably harder for potential buyers to qualify for loans, effectively shutting many out of the market. Adding fuel to the affordability fire is a shift in the supply and demand dynamic across several key housing markets. In Florida, for instance, a surge in available homes is causing prices to stagnate. Redfin data reveals that 6 out of 10 metro areas in the state have witnessed a significant rise in listings, like Cape Coral experiencing a whopping 51% jump. This influx of supply is forcing sellers to slash prices at a higher rate than the national average. Northport, Sarasota, for example, has seen a staggering 48% of listings undergo price cuts, while Tampa and Cape Coral aren't far behind at 44% each. Florida's woes aren't unique. Texas is also experiencing a similar market correction, with McAllen and Dallas seeing notable increases in available properties. Houston and San Antonio, on the other hand, are witnessing significant price reductions. These market shifts can be attributed to a confluence of factors. Tom, a housing analyst, likened the situation to a brewing hurricane. He pointed out that overbuilding in cities like Austin, coupled with job market slowdowns, has led to a glut of houses on the market, pushing prices down by a substantial 22% in the past 6 months. The reasons behind the surge in Florida's home listings are more nuanced. A recent report revealed a troubling rise in credit card delinquency rates, with California, Texas, and Florida topping the list. Notably, the delinquency rates are highest in northern Florida, precisely the regions experiencing a spike in available homes. So with supply rising, a crucial question emerges. Who will buy these homes, especially considering the skyrocketing interest rates? The answer lies in price drops. Potential buyers with loan qualifications constrained by the higher interest rates will only be able to afford houses with significantly lower price tags. This creates a scenario where sellers desperate to offload their properties are forced to reduce prices to meet the reduced buying power of potential buyers. In essence, a perfect storm is brewing in the housing market. Pinched consumers are putting their houses on the market, but to attract buyers in this environment with high interest rates, they'll have to slash prices considerably. This ongoing correction suggests that the American dream of homeownership might have to wait for calmer waters. If you're curious about why mortgage rates are at their current levels, it all ties back to the Fed funds rate, which is currently at 5.5%. This rate is what commercial banks pay to borrow money overnight from the Fed. The prime rate, which is what customers pay to borrow from banks, typically sits around 3% above the Fed funds rate, putting it at 8.5% now. So, for those keeping an eye on the news, simply tracking the Fed rate announcements from Jerome Powell gives a good indicator of where mortgage rates might head. If a rate drop is anticipated, it could happen around September or October, making the upcoming summer a potentially advantageous time to buy property. Closing on a property in August or September could be strategic, as sellers who have been on the fence might finally decide to act, not wanting to wait any longer in hopes of lower rates. In conclusion, the housing market is facing a difficult situation with a combination of rising interest rates, potential price drops in some areas, and an uncertain future. Homeownership remains a distant dream for many due to affordability challenges. However, there might be a window of opportunity for strategic buyers if the Fed rate drops in the fall. It's important to stay informed about economic news and housing market trends to make the best decisions about buying a home. It's important to weigh all the factors involved and do your research before making any decisions about buying a home.